Welcome to Simple Investing Secrets. In this video, we'll review the 15 reasons you should buy Alphabet stock now. So before we start, please like this video and subscribe to our channel for weekly updates. Let's get started. Alphabet stock tickers, GOOG, and GOOGL, may be one of the most powerful companies in the world, but that hasn't stopped it from getting swept up in the market sell-off this year. Shares of the Google parent are down 33% year to date as fears of a recession, rising interest rates, and a slowdown in the ad market have combined to sink the stock. However, sell-offs like these can often translate into buying opportunities. Let's review our top 15 reasons why Alphabet stock is a buy in 2023. Number 1. It has a monopoly. Most monopolies are banned by antitrust laws, but Alphabet has a loophole. Since the quality of a search engine improves as more users do searches, that makes search a natural monopoly. The industry doesn't lend itself to competition, and that means it will be especially difficult for a competitor to unseat Google as the search leader. Google has more than a 90% market share in search around much of the world, giving it tremendous market power, huge profits, and an entrenched brand in technology, and that's unlikely to change. Number 2. Google's formidable moat. Stocks that have an enduring competitive advantage are safe investments and have moats. Examples of moat industries include cable companies, given the massive costs of building new wiring infrastructure, or Coca-Cola, which has an iconic name among consumers. Google certainly has a moat in the internet. This is particularly impressive given the rate of change and intense competition on the web, whose flat structure means anyone can build a competing service. Google, on the other hand, has been able to gain and keep its lead by giving better results faster than its competitors. It has also been able to increase its market share with its Chrome browser and Android operating system, and it pays Apple to be the default search engine on Apple mobile devices. Number 3. Its profit margins are huge. Historically, Alphabet's operating margins have hovered in the 25% to 35% range. But it's more complicated than that. Even more lucrative than before is Google's core search operation. The operating margin in Google services, which includes its advertising business as well as hardware, Google Play, and YouTube subscriptions, came in at 32% compared to 25% overall for the company in its most recent quarter, even though the company's overall business struggled. Although Alphabet doesn't disclose operating profit for specific businesses like search, it is probably higher than Google services. Number 4. Google Cloud could be a juggernaut. Google Cloud, Alphabet's cloud infrastructure business, trails behind rivals like Microsoft Azure and Amazon Web Services, but it is growing quickly, with revenue up 38% to $6.9 billion in its most recent quarter. Unlike its two larger peers, Google Cloud is still losing money, but that should change over time. Its margins are improving. The division's operating margin narrowed from -14% to -10% in the third quarter, and management said on the recent earnings call that it is focused on a long-term path to profitability for the cloud segment. While it may never be as profitable as AWS or Azure, it should eventually be a significant contributor to the bottom line. Number 5. The ad market is cyclical. Part of the reason why Alphabet stock is down is that the ad market is slowing as businesses prepare for a potential recession. Alphabet's revenue grew just 6% in the third quarter. Advertising is a cyclical industry, and the same thing happened to the company when the pandemic began and during the financial crisis in 2008 and 9. However, the economy will eventually bounce back as we move through the cycle, and that means ad revenue at Google will accelerate too. Number 6. Other bets could eventually pay off. In addition to its search and cloud businesses, Alphabet has a number of moonshot projects it classifies under other bets. The best known of these is Waymo, its autonomous vehicle or AV division. Other bets has lost more than $20 billion in the last 5 years and brought in little revenue. However, that could change. If AV technology ever breaks through, it will almost certainly be a massive industry. The company also puts money into projects in the life sciences, such as fighting cancer and making products that help people stay young. Any of those projects could move the needle for Alphabet down the road. Number 7. It's tightening its belt. It's easy to argue that Alphabet has spent too much on other bets with little to show for it, but the company is planning to rein in costs, saying on the recent earnings call that it would slow hiring in the fourth quarter and into next year. It's unclear if it's planning to apply the same cost discipline to other bets, but investors should be encouraged by the spending controls. While Alphabet hasn't announced the kind of large-scale layoffs that fellow FANG stocks like Meta Platforms and Amazon have, that's also a possibility, as CEO Sundar Pichai has said that productivity is not up to par. Number 8. Thriving in tough conditions. The Great Recession in 2007 to 2008 was a massive stress test that many companies failed. Like all stocks, Google was also badly damaged by the selling pressure, falling 65% from its high at the tail end of 2007 to early 2009. However, once the stock market recovered and the economy began to show signs of growth, the company recovered all its losses in just 3 years. More importantly, even while the economy weakened over this time period, Google maintained growth in revenues. Additionally, during the Great Recession, many of its competitors were unable to survive, with others falling to the brink of bankruptcy. Number 9. Share buybacks will have an impact. Alphabet has long been a cash machine, but the company has stepped up efforts lately to return some of that cash to investors rather than just keep it on the balance sheet or spend it on projects like other bets. Over the last year, the company has repurchased 433 million shares, spending $43.9 billion on stock buybacks over the last 9 months. Those repurchases reduced its share count by 3.2%, and with the stock price down and $116 billion in cash and equivalents on the balance sheet, the company could get more aggressive with the repurchases, which will help increase earnings per share. Number 10. The stock is cheaper than the S&P 500. On a trailing basis, Alphabet stock trades at a price-to-earnings ratio of just 19.5, which compares to the S&P 500's at 20.5. Price-to-earnings ratios are based on a company's future earnings growth, so the market seems to be saying that Alphabet will grow profits more slowly than the broad market. Given the company's track record, its dominance in search, and its share buyback program, that seems like a mistake. While the business may struggle over the next year if a recession hits, it will bounce back over the long term. Number 11. YouTube could make a streaming splash. YouTube isn't generally thought of as a major competitor in the streaming wars, but that's changing. The video sharing platform has no true peer on the free side, and paid options like YouTube TV and YouTube Premium should help the company monetize that sticky user base. Together, the two services now have more than 80 million subscribers, up from 50 million a year ago, making them a legitimate competitor to both Netflix and Spotify. Number 12. Google has a firm grip on search engine domination. Even with the rise of YouTube and Google Cloud, the majority of Alphabet's business is still Google Search, its original moneymaker. Google Search generated $39.5 billion in revenue in the third quarter, 57.2% of Alphabet's overall revenue. Although the nominal annual revenue growth was only 4.2%, the US dollar's strength made it likely that the actual annual revenue growth was much higher. The amount of money Google makes outside of its home market this year will be reduced. Why is Google Search revenue still growing? It's simple, the service has a virtual monopoly on the search engine market and is riding the steady growth of internet users around the globe. Google Search has a market share of 90% or higher in the majority of nations worldwide, excluding China, according to independent estimates. Several hundred million new users join the internet each year, and those who already use it spend more time doing so. This means more of an opportunity for Google to serve advertisements as people search for information and products. No matter what people are searching for on the internet, the vast majority are doing so through Google Search, making a boatload of money for Alphabet in the process. Unless something drastic changes within the search engine market, Google's dominance should continue for the foreseeable future and lead to consistent top-line growth. Number 13. Alphabet stock receives positive analyst ratings. Wall Street continues to be very bullish on Alphabet stock, as evidenced by the fact that 48 of the 51 sell-side analysts covering the company's shares have assigned either a buy or strong buy rating to Google. However, as this is a crucial sign of investor sentiment, it is the change in analyst ratings over time rather than the absolute rating that matters. Number 14. Google stock is a good long-term investment. Alphabet's recent metrics send positive signals about its long-term growth outlook. It is amazing that Alphabet has a strong financial position now, even though it just executed on the largest quarterly share buyback in the company's history in Q2 2022. Google has an estimated $125 billion in cash and short-term investments on its books as of June 30, 2022. Considering the free cash flow generative nature of the company's business, Alphabet's cash pile is very likely to continue growing in the years ahead. Many companies fret about the inability to generate positive cash flow, a weak balance sheet, and the lack of excess capital needed to support future growth or reward shareholders with capital return. This isn't Google's problem. Alphabet is among a minority of companies that has the financial strength to support both capital investments and capital return. In fact, it is reasonable to assume that Google will allocate an increasing proportion of capital to share buybacks and other shareholder capital return initiatives over the coming years. Number 15. The track record is clear. Alphabet's sales and profits have grown steadily since it went public in 2004. This has given investors a return of nearly 4,000%. Though the stock is down substantially over the past year, Alphabet is arguably stronger than it's ever been. It has a monopoly on search, and since Apple stopped ad targeting, advertiser budgets have moved from social media to search. The company has plenty of money to return to shareholders through buybacks, and the ad market should continue to grow over time, especially with the emergence of connected TV, including YouTube. Despite the stock's woes, Alphabet's best days are still ahead. Alphabet stock is definitely a buy-rated company in our view. There are many things that long-term investors will like about Alphabet. These include the potential for increased shareholder capital return, the positive expectations of operating profit margin expansion, and the long growth runway for Google Cloud. This concludes our analysis of the top 15 reasons to purchase Alphabet stock. Tell us in the comments below if you think it's a good time to buy Alphabet stock right now. And don't forget to like this video and subscribe to our channel for weekly updates on the best stocks to buy and cutting-edge investment strategies. Thank you for watching, and best of luck with your investments.